Assalamualaikum. We are from Group 4. Want to present about topic 8, real property gains tax. This is the content that we will discuss for today. So I will pass to the first presenter.
Assalamualaikum and hi everyone. My name is Atira Khairi and my matrix number is 27229. So today I will begin the group's presentation about real property gains tax. So as you can see on the first slide, these are the related provisions from the RPGT Act 1976 that will be mainly used in the explanations of this topic. All of these sections will be helpful for all of us in obtaining the depth understanding of this topic. The first case that I will discuss under the assessment and collection is related to the case of Ketua Pengarah Hasil Dalam Negeri versus the Patali Rubber Estates Limited. So basically this company own and manage the oil palm crops on a number of several pieces of agricultural land, which is referred to as the said land. So, by a sale and purchase agreement dated April 23 in 1999, the appellant sold the aforementioned land to its subsidiary Pulau Keri Properties Sendirian Berhad for a total purchase price of 200 to 500,000 ringgit Malaysia. The sale and purchase agreement were contingent on the foreign investment committees and, if appropriate, the estate land board's permission for the sale of the agricultural land. So the main problem for this case is that the two approvals were never acquired. In addition, the buyer had made no payments toward the purchase price, not even the required down payment. The deposit was subsequently waived when the sale and purchase agreement was terminated. The parties did not complete a transfer instrument on Form 14A, and the transfer of the land to Pulau Keri Properties Sendirian Berhad was never recorded with the relevant land office. The appellant argued that the transfer registration was irrelevant. According to Section 51A of Schedule 2 of the RPGT Act 1976, the land was disposed of when the parties executed a written agreement, not when the transfer was recorded. Even though the sale and purchase agreement had been executed, the respondent argued that ownership had not been transferred to the buyer. Since there was no transfer of ownership, there was no disposition. Since no disposal occurred, there was no charge per gain. Real property gains tax is triggered when there are two conditions happen. The first one is when the real property is sold, and the second one is when the charge per gain is realized as a result of such sale. The second case for the assessment is about the case of Mudik Sendirian Berhad versus Kerajaan Malaysia in year 2004. So, the taxpayer appealed the decision of the Learned High Court Judge who allowed the plaintiff to obtain summary judgment over an alleged claim for charge per gain under the Real Property Gains Tax Act of 1976. So, the taxpayer's primary contention was that the act was not triggered in this instance since there was no charge per gain as per Section 3 of the Act, and the property had not been sold or no purchase money received under Section 2 of the Act. The fact that the taxpayer had signed a sale and purchase agreement with a buyer was not in question. It was asserted that the purchaser had not met the terms of the sale, and the taxpayer had filed two lawsuits in the High Court for the failure to pay the respected purchase price. According to Section 3 of the Act, our government has imposed a tax on the charge per gain. So, the taxpayer maintained that the property had not yet been disposed of within the meaning of Section 2 of the Act for the government to levy an assessment on the charge per gain due to the non-payment of the purchase price. So, the government's position is that once the assessment was issued and the assessee contested it, he will meet the definition of aggrieved person under Section 99 of the Income Tax Act of 1967. The last case under the assessment and collection would be the case of Ang Lei Kim versus Pengarah Hasil Dalam Negeri Malaysia, Johor Bahru. The complainant was a Malaysian until he accepted Singaporean citizenship on January 23 in 1988. The plaintiff acquired 1/8 of a property from his deceased mother on January 29 in 1987. The plaintiff additionally signed a declaration of trust, claiming that he held just 1 out of 40 of the 1 out of 8 of the property and held the other 4 out of 40 in trust for his 4 Malaysian citizen sisters. The plaintiff and the 10 other owners sold the property for 2.4 million, while a sale and purchase agreement dated June 6 in 1996. The plaintiff was awarded roughly for about 306,000 ringgit Malaysia, of which he kept for about 61,000 for himself and gave the remainder to his sisters. On February 19 in 2007, the defendant issued an assessment notice for the year 1996, assessing real estate gains tax and penalties totaling 74,229.32 cents. The plaintiff challenged the notice of assessment and sought, among other things, the following orders. The first one, a declaration that the notice of assessment issued by the defendant for the year of assessment 1996 for RPGT in the amount of 74,000 was invalid and must be revoked. And secondly, a declaration or order that the plaintiff did not owe the defendant any real property gains tax and did not need to pay the defendant the sum of 74,229.32 cents. The application basically is denied, so the plaintiff's application for a declaration should not have been filed as an originating summons, but rather as an application for judicial review under Rule 053 of the High Court Rules of 1980. If the plaintiff was dissatisfied with the aforementioned notification, the appropriate remedy was an appeal to the Special Commissioners of Income Tax pursuant to Section 18 of the RPGT Act of 1976. For purpose of the real estate gains tax, the plaintiff was a taxable person. As the taxpayer was not a tax resident at the time of the property sale, the 30% real property gains tax was correctly assessed. Now, I will explain briefly about the main and important concepts of chargeable gains and allowable loss. First, in a situation that there is no gain or loss of a disposed asset, it means that the disposal price is equal to the acquisition price. Secondly, when there is an arise of chargeable gain from the disposal of the respective asset, this means that the disposal price is much more greater than the acquisition price. Otherwise, when the disposal price is less than the acquisition price, the allowable loss will occur in the meantime. Now, we will discuss about some of the related law cases under the chargeable gains and allowable loss. The first case is the AT Sendirian Berhad versus Ketua Pengarah Hasil Dalam Negeri, dated back in year 2004. The date of incorporation for the taxpayer was February 14 in 1979. On April 29, it acquired around 1,453 acres of agricultural land. Upon the acquisition, the land was subdivided into thousands of residential and commercial lots, which were then subdivided and sold. The relevant lots were categorized as fixed assets in the taxpayer's accounts as of the date of acquisition. On April 28 in 1983, the lots were separated from the trading lands, and the expenditure on fixed assets retained for investment purpose was transferred to the capital account. The sale of the subject lots, according to the DGIR, is an adventure in the nature of trade, and the gains from such a sale are taxable under Section 4A of the Income Tax Act 1967. Nonetheless, the taxpayer contended that the gains from the sale of the subject lots are taxed under the RPGT Act 1976 rather than income tax under Section 4A of the IDA 1967. The gains from the sale of the subject lots were taxable under Internal Revenue Code Section 4A. The only inference that could be drawn based on the basis of comments that would be applicable in this situation and the taxpayer's objective in acquiring the subject lots was an adventure in the nature of trade. The taxpayer's articles of incorporation also support this conclusion. Next, the second case is obtained from the Turuntum Theatre Sendirian Berhad versus KPHDN. The taxpayer was taxed on real property gains pursuant to the RPGT Act of 1976 on the gains realized from the sale of the subject property, and a certificate of clearance was given when the assessed amount was paid. The IRB, however, changed its mind and taxed the gains under Section 4A of the Income Tax Act of 1967, notifying the taxpayer that the real property gains tax paid would be credited to the taxpayer's income tax account. This was carried out as expected. After having assessed the taxpayer for real property gains tax under the RPGTA, and upon payment of the assessed amount and issuance of a certificate of clearance, whether the IRB could vacate the assessment and reassess the taxpayer for income tax on the same receipt as a trading gain under the ITA, and secondly, whether on the merits, the special commissioners were correct in concluding that the sale of the lands constituted a trading gain. So, the estoppel which the taxpayer relied on could not be invoked against the Director General of Income Tax, where he was put on notice that an improper assessment had been made under the RPGTA. The Director General could not create an estoppel against himself from performing his statutory duty to raise a correct assessment under the appropriate law. No individual can claim an estoppel against himself so as to defeat a positive responsibility placed upon him by a statute. So, the obligation of both parties, the Director General and the taxpayer, was to obey the stated law. There was therefore no rule of law precluding the Director General from discharging the assessment under the RPGTA and proceeding with an assessment under the Income Tax Act of 1967. On the second question, the Special Commissioners had carefully studied the evidence that the elements taken into consideration were relevant information, and they had used the correct principles to judge this law. For the third case, under the subtopic of RPGT, I will explain briefly about the case related to Bukit U Sendirian Berhad versus TGIR. The appellant company was founded on November 29 in 1963. The appellant acquired a piece of land on June 26 in 1996, and this respective land was sold on November 17 in 1978, which is 40 years later. On the gains, the appellant was charged a real property gains tax which was paid to the respondent. On 5th of July in 1980, the respondent assessed income tax in the amount of $179,000 against the gains resulting from the sale of the aforementioned property. Before the Special Commissioners and the court ruled, the question was whether the appellant's sale of the aforementioned land constituted a commercial adventure. The Special Commissioners determined that the transaction constituted a commercial risk and affirmed the finding. As the case stated, the appellant appealed to the High Court. The High Court found the Special Commissioners to be in error. The last law cases would relate to the case of M Holdings Sendirian Berhad versus Ketua Pengarah Hasil Dalam Negeri. So, the taxpayer was a corporation incorporated on November 9 in 1984, whose primary business was real estate development. A property, which is referred as the subject property in this case, belonging to Selangor Industrial Corporation Sendirian Berhad, was injected into the taxpayer's accounts in May 1989 at a cost of 25 million ringgit Malaysia, pursuant to a joint venture agreement. The subject property was classified as fixed assets in the taxpayer's financial statements for the years ending January 31st in 1990 and 1991, then as current assets beginning in 1992. For your information, in 1990, development expense were categorized as current assets. Next, for the year ending January 31st in 1995, however, the relevant property was included in the accounts as investment property. The relevant property was later sold on April 11 in 1995, 4 days after the directors and auditors of the taxpayer signed the financial statements of the respective company. After selling the subject property, the taxpayer filed a return of disposition of chargeback assets in accordance with the RPGT Act of 1976. The Director General consequently raised a corresponding assessment. Subsequently, a new assessment was issued pursuant to Section 4A of the ITA of 1967. The taxpayer was displeased with the subsequent assessment and therefore filed this appeal. The conditions of the joint venture agreement made it quite evident that the taxpayer intended to develop the property for sale from the outset. even during the time when the subject property was shown as a fixed asset in the accounts. Other facts and the taxpayer's acts and conduct demonstrated that the taxpayer intended to treat the subject property as a trading stock rather than as a fixed asset. That's all from me. I will pass on to the next presenter. Thank you.
Hi and Assalamualaikum everyone. My name is Anisha Nabila binti Zaman with metric number 272837. Now I will continue the presentation about the acquisition price losses. First, what is acquisition price losses? Acquisition price is the amount of the consideration in money or money worth given by or on behalf of the owner wholly and exclusively for the acquisition of the asset, less compensation received, insurance recoveries, and deposit for time. The example of acquisition price losses are: first, Young MF versus Ketua Pengarah Hasil Dalam Negeri 2003. The taxpayer owned a piece of land which was acquired on 7 November 1970. On 30 December 1993, the taxpayer entered into a joint venture agreement with a developer to develop the land into a residential housing estate in return for 6 units of houses. In 1995 and 1996, the taxpayer disposed of the 6 units of houses. The DGIR raised RPGT assessment for the relevant years in respect of this disposal. Based on the valuation done by the Jabatan Pilihan dan Perkhidmatan Harta Negeri Pahang, Kuantan on 2 March 1999, the market value of the land as at 30 December 1993 was taken as 343,000, and the taxpayer disagreed with the assessment raised and lost an appeal. The appeal is dismissed because the exchange of the land for the house by the joint venture agreement was a disposal of the said land and exploitation and acquisition of the houses. Pursuant to paragraph 15, Schedule 2 of RPGT Act, the date of disposal of the said land was deemed to take place on the date of execution of the agreement in its 30 December 1993. Corresponding, the acquisition date of the houses should be 30 December 1993. Since there were no houses erected yet at the time the taxpayer disposed of his land to the developer in exchange for 6 houses, the acquisition price of the houses should be the market value of the said land, which is 343,000. The next cases of acquisition price losses are CW versus Director General of Inland Revenue 1989. The taxpayer later sold the house and was assessed real property gains tax. The taxpayer claimed a deduction of the loan interest in computing real property gains tax, contending that it was incidental cause of the acquisition. The question was whether the loan interest should be taken into account in computing the acquisition price of the property. Held, appeal is dismissed because the loan interest should not be taken into account in computing the acquisition price of the property. The next cases of the acquisition price losses is from Binastra Holdings Sdn Bhd versus Ketua Pengarah Hasil Dalam Negeri 2002. These cases about the holding and investment company that acquired a total of 75 shares at RM1 ringgit per share in Sukma Persona Sdn Bhd, the company which was in a business of developing property. The company was then the registered owner of the land which were alienated to it by the Selangor state government for purpose of development and sale as housing units. This land was subsequently converted for housing development, and on 6 April 1998, the taxpayer sold its 75,000 shares in the company to a purchase for 600,000. The respondent or the revenue assessed the taxpayer on this under Para 34A, Section 2 of the Real Property Gains Tax Act 1976. The taxpayer appealed to the Special Commissioner of the Income Tax was dismissed. The issue before the High Court was therefore whether the gains made by the taxpayer from the disposal of the share fell within the ambit of the Act. Held is appeal allowed because the taxpayer was not an individual who had used a company to acquire land and then dispose of shares. in that company, thereby avoiding payment of RPGT. When the taxpayer bought the share in the company on 25 June 1996, the company had already acquired the property to be development on 7 June 1995. The gains made under disposal of the share here therefore placed it outside the ambit of Para 34A, Section 2 of the Act. Next, I will continue about the disposal price preservation. The formula is the consideration in money or money worth for disposal of the asset, less permitted expenses, less paragraph 5, section 1c, which is the accidental cost. The total will get a disposal price. Now, what is disposable price? Disposable price is a deduction that will not be allowed for contingent liabilities, which we can see in paragraph 26, schedule 2, as in computing disposable price, any outgoing or expenses which are normally deductible for tax income tax purpose are discarded in arriving at acquisition price. The case related about the disposable price reservation is first Ketua Pengarah Hasil Dalam Negeri versus Chan Lian Yen 2010. In this case, the issue was the disposable price for the transaction. The respondent disposed of certain shares in CKSB. The respondent and another held 100 of the fully issued and paid up share capital of CKSB. Less than a month after CKSB entered into an agreement to purchase land, the respondent and the other entered into a share sale agreement. The appellant IRB raised an assessment under Real Property Gains Tax Act 1976. The respondent appealed to the SCIT, and the CIT found that the disposal price was the purchase price of the share, and the IRB appealed to the High Court. It was held that the appeal was allowed, and the disposal price should be the actual price of the share plus the purchase price of the land. Next cases is the TBC versus Director General of Inland Revenue. In this case, the taxpayer had agreed to purchase a pieces of land on 31st May 1979. On the same day, the taxpayer entered into another agreement with a contractor to build a house on the subject land with a payment to be made in 4 progress installments. By way of a 2 tripartite agreement, date 14 April 1980, the taxpayer assigned his interest to his sister-in-law, and the taxpayer was released from the contract between him and the contractor. The taxpayer contended that the transaction was novation and did not involve any transfer of property. He argued that the disposal was merely a disposal of an interest in land and a contractual obligation to the contractor, or that the assessment of the value of the land was excessive. The taxpayer did acquire land within the meaning of the Real Property Gains Tax Act 1976. There was also a disposal of the said land by the taxpayer. The value of the land for the purpose of determining chargeable gain should be its market value as at the 31st December 1979 and not 14 April 1918. Next cases is the TBC versus the Director General of Inland Revenue. In this case, the taxpayer had agreed to purchase a pieces of land on 31st May 1979. On the same day, the taxpayer entered into another agreement with the contractor to build a house on the subject land with a payment to be made in 4 progress installments. By way of the 2 tripartite agreement, date 14 April 1980, the taxpayer assigned his interest to his sister-in-law, and the taxpayer was released from the contract between him and the contractor. The taxpayer contended that the transaction was novation and did not involve any transfer of property. He argued that the disposal was merely a disposal of an interest in land and a contractual obligation to the contractor, or that the assessment of the value of the land was excessive.
Thank you, Anisha, for your great presentation. By referring to the slide, I will explain to you guys about the details of the transaction that occurs at the market value. A person's acquisition or disposition of an asset is presumed to be for a price equivalent to the item's fair market value. I will explain it to you guys in 5 details. The first one is where he buys or disposes of an asset other than through an arm's length transaction, and in particular where he acquires or disposes of it through a way or gift. The second one is where he acquires or sells the asset entirely or partially through 3 different ways. The first one is for an unvalued consideration. The second one in connection with his or another's loss of office or employment or reduction in emoluments. The third one in consideration for or recognition of his or another's service or past service in any office or employment, or of any other service rendered or to be rendered by him or another, or in consideration for or recognition of his or another. The third method is if he acquires an asset as trustee for the creditors of a person in full or partial settlement of a debt owed by that person, or if he transfers an asset as trustee for the creditors of a person to the creditors in whole or partial satisfaction of a debt owed by the creditors. And the fourth method is he buys or sells an asset in a transaction involving the sale of a business for a lump sum. And the fifth method is where section 25 second applies.
Assalamualaikum. My name is Nadia binti Jamaluddin. My metric number is 273478. So I would like to present the 8.2.4 market value. The paragraph 11 of Schedule 2 RPGT Act 1976 defined the market value as the price which the chargeable asset will fetch if it was sold in a transaction between independent persons dealing at arm's length at the time of the acquisition or disposal. The market value shall be determined by the Director General if, first, the parties to the disposal of an asset are unable to agree of its market value, there is only one party to the disposal of an asset, or the Director General is of the opinion that the market value of an asset as agreed on by the parties to its disposal is incorrect. The case related to market value is GC Sendirian Berhad versus Kota Pengarah Hasil Dalam Negeri. The taxpayer or property developer acquired shares in a real property company and disposed of the shares within the same year. The inland revenue took 40,586,000 as the market price of the land at 27 January 1995 and compute the acquisition price of the 28 million shares to be Rm 22 million based on the valuation by a government valuer. The taxpayer claimed that the acquisition price of the 28 million shares should be Rm 1,101,000,000 based on Rm 182 million, which is the defined value of the asset acquired. The issue for the determination before the SSIT was what should be the acquisition price for the computation under the RPGT Tax Act 1976. So, the SCIT held that the comparison method of valuation adopted by the government valuer is the better method of valuation compared to discounted cash flow adopted by the private valuer. The taxpayer valuer failed to use a comparable sales of similar lands of similar quality in the locality at or prior to the time of acquisition as the basis of valuation. Next, the best approach was to take on the average price of the best 3 comparables in the government valuation and make the necessary adjustment in respect of certain dissimilarities. As such, the acquisition price of 28 million shares was computed to be Rm 57,130,000 and the inland revenue was ordered to amend the notice of assessment. The next cases is Bukit Raja Rubber CO Limited versus Collector of Land Revenue Klang 1968 1 MLJS 176B. According to the case, the court held that the property must be valued not only with reference to its condition at the time of acquisition, but also its potential development value. Ordinarily, the objective assessment would be the price that an owner willing and not obligated to sell might reasonably expect to obtain from a willing purchaser. Next cases is Alagapa, Chetia versus Collector Land Revenue, Kuala Lumpur. The court held that the market value therefore does not mean simply the value of the land from the manner it is being actually used for the time being, but includes all future possibilities on which a prudent purchaser would calculate and a vendor will base his expectation, both parties being actuated by business principles. That is to say, market value necessarily includes the potential value, if any. Next cases is Bertam Consolidated Rubber Company Limited versus Collector Land Revenue, Province Wellesley. The court held that in an era of rapid economic and social developments, estate or agricultural land in this country must necessarily have a development potential, particularly when the property is situated in the vicinity of an existing town. The development potential can be immediate or remote. The more immediate the potential, the higher will be its market value. In considering how immediate or remote such potential is at the relevant time, regard must be had to all the circumstances, including similarities and dissimilarities between the land acquired and comparable land in the neighborhood. Next case is Ng Thiau Hong versus Collector of Land Revenue Gombak 1984 to MLJ 35. In this case, the appeal was against the decision of the High Court, Kuala Lumpur, relating to the market value of 147 acres of land in Gombak, Selangor. The land had been subdivided into portions and valued separately, the northwest portion at 30,000 per acre and the rest at 15,000 per acre. The court held that 1. Adopted the principle of valuing the scheduled land as a whole, especially in cases where the area is large and is owned by numerous individuals in different portions. Next, the scheduled land should be valued at about Rm 70,000 per acre. The big area of the land, its location and nature did not render it easily marketable as the smaller lots in the neighborhood. In the determination of the market value, the safeguard is evidence of similar lands of similar equality or position in the locality or at the prior of the time of acquisition. Next cases is PPH versus Director General of Inland Revenue 1988. The taxpayer sold a piece of land for Rm 22,525,000 for an urgent need of 20,000. The IRV valuer assessed the value of the land at Rm 50,000 and the taxpayer was assessed to RPGT accordingly. The IRB contended that it was empowered to do so pursuant to the provision in paragraph 11. It was held that IRB could not impose a market value on the land on the basis of its valuation report for the purpose of computing RPGT in the circumstances where the disposal was an arm's length transaction between independent parties. The IRB should have taken into consideration the taxpayer's financial situation. The last cases for market value is BO versus Ketua Pengarah Hasil Dalam Negeri, year 2009. In this case, the question arises as to whether the market value of land determined by the IRB on the disposal of real property was the correct market value for RPGT purpose. The taxpayer purchased a piece of land at the price of 330,000 in 1998 and subsequently sold the land in 2001 at the same price. In assessing the gain subject to RPGT, the IRB used the Valuation and Property Services Department value of 798,000 as the disposal price. The taxpayer argued that the actual disposal price of the land was Rm 330,000 as stated in the sale and purchase agreement. However, the taxpayer also submitted a valuation report from a private appraiser which showed the market value of the land at the time of sale to be Rm 470,000. The Special Commissioners SC held that the market value determined by the Valuation and Property Service Department was reasonable and fair. Paragraph 11, 2C, Schedule 2 of RPGT Act 1976 says that the valuation should be based on factors including the location, the size of the land, the terrain, ownership condition, market condition, etc. On the fact that SC found that the appropriate market value of the land for the purpose of RPGT was Rm 798,000. I would like to pass the presentation to another presenter.
Assalamualaikum. My name is Nuzaira binti Muhammad Zamri. My matric number is 272844. I want to discuss about disposal and acquisition dates. The disposer should identify the date of acquisition and disposal of asset as both dates will affect the tax rate imposed. For disposal date, we deal on the date of agreement if there is a written agreement, or on the date of completion of the disposal of the asset if there is no written agreement. The date of completion of a disposal here means the date of ownership of the asset is transferred by the disposer, or the date on which the whole of the amount or value of the consideration for the transfer has been received by the disposer. Whichever is earlier, they were considered. The date of acquisition of the asset by the acquirer shall be deemed to coincide with the date of disposal of that asset by the disposer to that acquirer. The first case that I want to discuss under the disposal and acquisition date is the case related to TBC versus DGIR. The taxpayer had agreed to purchase a piece of land on May 31, 1979 by way of two tripartite agreements dated April 14, 1980. The taxpayer assigned his interest to his sister-in-law, and the taxpayer was released from the contract between him and the contractor. Despite the date of the agreements on 14 April 1980, the assignment of the asset to his sister-in-law was agreed to earlier, on December 31, 1979. The taxpayer was assessed a real property gains tax for the year of the assessment in 1980 in respect of the disposal. The taxpayer appealed against the assessment. The taxpayer contended that the transaction was a novation and did not involve any transfer of property. It was therefore not a disposal within the meaning of the Real Property Gains Tax Act 1976. Held for this case is the taxpayer did acquire land within the meaning of Section 2 of the RPGT Act 1976. Under this section, an allowable loss means a loss suffered on the disposal of a chargeable asset which, if it had been a gain, would have been chargeable with the tax. The value of the subject land with the foundation work for the purpose of determining chargeable gain should be its market value as at 31st December 1979 and not 14 April 1980. Next case is Wellbeck Securities Limited versus Paulson. The taxpayer acquired an option to participate in a property development. On May 31st, 1974, as a result of a consent order, the taxpayer was paid the sum of €2 million by two property development companies. In consideration of that payment, the taxpayer company agreed to release and abandon the option claimed by it at a particular development site. The taxpayer company was assessed corporation tax in respect of the receipt by it of the €2 million. An appeal against the assessment was allowed by the Special Commissioner on 2nd August 1984. The issue is whether that figure of €962,229 in respect of chargeable gain should be excluded from the assessment. The taxpayer had abandoned the option with the result that para 14 subsection 3 of Schedule 7, which provided that the abandonment of an option did not constitute a disposal, prevented the liability to tax arising which would otherwise be chargeable under Finance Act 1965, Section 22, Subsection 3. The revenue resists that contention and claims tax in respect of that gains. Next case is OBD versus DGIR. In this case, the taxpayer purchased two shop lots which were paid out in full on 18 September 1984. The taxpayer sold the shop lots on 13 August 1985, the same day on which all the rights, title, interest and liabilities in the shop lots were transferred to the taxpayer by way of a deed of assignment. The taxpayer was assessed a real property gains tax and the IRB took 18 September 1984 as the acquisition date of the property. It was held that the ownership of property was effectively transferred when the deed of assignment was executed. The date of the acquisition of the shop lots was changed to 13 August 1985. Next is the case of Ponti SO versus KPHDN. In this case, the taxpayer purchased land from the vendors in her capacity as trustee under a 16 November 1973 agreement. The purchase agreement provided for the purchase price to be paid in installments. The taxpayer sold the land before the last installment was paid and before the property was ever vested in her. The purchaser paid the final installment to the vendors on behalf of the taxpayer, and the vendors transferred the property directly to the purchaser on 1st December 1981. It was held that the acquisition date was the date when the ownership of the right in or over land was deemed to be transferred from the vendors to the taxpayer, because the acquisition date must not have been later than the disposal date on 1st December 1981. There had to be a brief transfer of right of ownership to the taxpayer on that date, prior to the sale of the property to the purchaser on the same day. Next is the case of AM versus DGIR. In this case, the issue was when was the date of acquisition of the land from BKNS. In this case, the taxpayer had bought a piece of land from the Selangor State Development Board, BKNS. He later sold the land and was assessed a real property gains tax. The taxpayer contended that the date of acquisition was either June 10, 1975, based on the PKNS letter of offer of the same date, or 29 March 1976, when the taxpayer had paid 90% of the purchase price to PKNS. The DGIR argued that the date of acquisition was 4 January 1980, being the date when the final 10% payment for acquisition was made. The Special Commissioners held that the acquisition of the land from PKNS was made on 29 March 1976, as the disposal of the land by the taxpayer took place more than 7 years after the date of acquisition. No RPGT was payable. Next is the case of TKF versus DGIR. In this case, the taxpayer had entered into a sale and purchase agreement with a developer to purchase a house on 27 June 1974. The taxpayer made an advance payment and progressive payment with his own money. The balance of the purchase price was taken from a loan given by the developer. On 8 July 1988, the taxpayer paid the full purchase price. On the same day, he disposed of the shophouse to a third party. The taxpayer was assessed a RPGT on the profit. He argued that his acquisition was effective on 27 June 1974, and since the RPGT Act only became effective after the date, the gains made from the sale should have been tax exempt. This was clear from the terms of the sale and purchase agreement. The taxpayer did not have any title to the shop house before 8 July 1988 other than as a mere license. Last but not least, case of Young MF versus KPHDN. The taxpayer purchased a piece of land on 7 November 1970, and on 30 December 1993, the taxpayer entered into a joint venture agreement with a developer to develop the said land into a residential housing estate in exchange for a number of completed houses. Subsequently, the taxpayer disposed of the houses in 1995 and 1996. The taxpayer contended that he was not liable to RPGT on the sale of houses in 1995 and 1996, as the land concerned was acquired in 1970, and as such the disposal of the houses took place more than 6 years after the purchase. Further, the taxpayer sold the houses at the developer's price and therefore contended that there was no gain. The Special Commissioner held that by the deeming provision of Para 15, Schedule 2 of RPGT 1976, the date of disposal of the said land was deemed to take place on the date of execution of the agreement, which was on 30 December 1993. The acquisition date of the houses was therefore on 30 December 1993. The houses were disposed of in 1995 and 1996.
Thank you, Zahira, for your detailed explanation. For the last part of my presentation, I will explain about the deductions that are allowable only once. According to the RPGTA, no individual may claim a deduction for the sale of an asset more than once in a computation made pursuant to this legislation. That's all from me. Thank you.
Now I will continue the presentation about the certain losses not allowed. A loss incurred as a result of this disposal is not allowable if A. The date of disposal was before the date of a coming into force of this Act. B. Any gain accruing in respect of disposal will have been exempted from the tax under this Act. C. The disposal is not included in the return made under Subsection 13(1) or 2. And the last one, D. The disposal is a chargeable asset under Paragraph 34A. Not included in the return made under Subsection 13(1) or 2, because every chargeable person who disposed of a chargeable asset and every person who acquired the asset so disposed of shall, within 60 days or such further period as the Director General may allow, on a written request being made to him of date of disposal of the asset, make a return, first specifying the respect of the asset disposed of, the acquisition price, disposal price, and the gain or loss on the disposal. Second is the differentiating all information necessary to determine the acquisition price and disposal price of the asset disposed of. And the last one is whether the market value of the asset is to be taken for the purpose for this Act. Submit a written valuation of the asset by a valuer. In 2, every nominee shall, within 60 days or such further period as the Director General may allow, on written request being made to him, of the date of disposal by him chargeable asset on behalf of any person, make a return specifying first the name and address of the person on whose behalf the disposal was made. The second is the asset disposed of, and the third one is the date on which he began to hold the asset as nominee for that person. The disposal is the disposal of the chargeable asset under paragraph 34A. The acquisition and disposal of share in a real property companies, 34A section 1. An acquisition of share in a real property company should be deemed to be an acquisition of chargeable asset, and when such shares are disposed of, such disposal shall be deemed to be disposal of chargeable asset, notwithstanding that at the time of disposal of such share, the relevant company is not regarded as a real property company. Now I will pass to the next presenter. Thank you.
8.3 Chargeable Persons. The chargeable person is specified under Section 6 RPJT Act 1976 that states every resident or non-resident in Malaysia shall be chargeable with the tax for the assessment year subject to chargeable gain accrued from the disposal of chargeable asset. The chargeable person is specified under Schedule 1 of RPJT Act 1976 as the following. Firstly, the body of the persons, partnership and co-proprietorship. Second is incapacitated persons, who is the trustee, guardian who is having control or management on behalf of incapacitated person appointed by court. Thirdly, non-resident, which is a person who is absent in Malaysia. Fourthly is rulers and ruling chiefs. 5 companies. 6 Hindu joint family. 7 is executor in the case of estate of deceased persons. 8 is trustees other than trustees of incapacitated person. 9 joint and several liability of trustee and executors in the case of having 2 or more trustees of a trust or executor of the estate can be jointly to liability for the tax payable on any chargeable gain accruing to the trust or estate. Last but not least is responsibility of specific persons. That's all from me. I would like to pass the present to the next presenter.
I will continue the discussion. As you can see here, there is a rates of tax for individuals based on Schedule 5. Last but not least, I will discuss about exemption. Under RPJT Act 1976, exemptions are available in following circumstances for your benefits. First, an individual who is a citizen or a permanent resident will be given an once in a lifetime exemption on any chargeable gain of private resident if he or she elect in writing for the exemption. Second, chargeable gain before the date of coming into force. Third, a gain accruing to the government, state or local authority, and an individual will be given an exemption equal to 10,000 ringgit or 10% of chargeable gain, whichever is greater. Last, transaction in which disposal price is deemed equal to acquisition price as stipulated as no gain, no loss transaction as per Schedule 2, Paragraph 3 of the RPJT Act 1976. That's all from me and my friends. Thank you for listening.